Ben, thanks very much for joining us today. How are things in London?
All good, thanks, Jimmy. Good to be back chatting to you.
So I want to focus this discussion on nuclear energy and uranium, and I'm sure you would agree with me when I say that there is no other commodity that has such a positive backdrop as uranium does. But I have to admit, I'm frustrated with the price action that we have seen this year, and especially with so much positive news. And the big news that we have seen here in the last couple of months is this emergence of big tech into nuclear energy. And the first company to announce this move is Microsoft and Constellation Energy. And I want to I wanted to start our discussion right here. What are your thoughts on this agreement, and what do you think it'll do to the uranium price?
Sure, I think that what we're seeing is, I was always told when we were looking at the uranium industry that there was always going to be something that you didn't expect that was going to be that sort of contributor to a much higher leg in terms of pricing. And I think that this is probably it. I think that, the uranium thesis had a lot of strength around it, and I think it still does, in terms of what we talk about as our base thesis, which is a sort of global nuclear renaissance. And then obviously looking at the fundamentals of uranium supply, which are incredibly favorable, we think, versus pretty much every other commodity story. But what I don't think that we even expected, albeit we sort of, understood that big tech would look at nuclear power at some point, we didn't expect to see such aggressive sort of, I guess, agreements and also funding coming from big tech towards this industry. Now, 3 Mile Island was an example, but we saw Amazon putting money to work via Talon Energy's plant earlier this year. We obviously saw Bill Gates, his early adoption of nuclear power via TerraPower, his small modular reactor company as well. So I don't think that big tech is new to the nuclear space. I think they've sort of been waiting patiently on the sideline for a time whereby they really, really needed the power. And for all of the reasons that your listeners will be familiar with, there is a sort of power supply crunch, particularly for big tech, particularly this sort of conflict between their ESG ambitions and their AI ambitions. And as big tech sort of scramble to win this AI race, they are sort of confronting this reality that there is a huge, huge power problem, specifically clean baseload power. So traditional data centers, call it a cloud data center, require 50% base load, so you can kind of have solar plus a battery. But this next generation of AI model training data centers, they need 90% plus capacity factors. And nuclear really is one of the only suitable solutions to this. We saw the likes of Constellation reporting a 98% capacity factor across their entire fleet in the US this summer. So it really is in a league of its own in terms of a solution to big tech's power problem. In terms of uranium demand, I think that the main implications for this are going to be, we've seen the low-hanging fruit start to be picked up by, the likes of Microsoft, 3 Mile Island. When I say low-hanging fruit, I mean restarts. These are the quickest way to get nuclear capacity back online. They're permitted, albeit they have drawn down fuel inventories to zero, which is where the real impact comes on uranium demand. I think that when you look at most uranium analysts, sell-side analysts, supply-demand models, let's take the US as an example. Most had US nuclear capacity flatlining between now and 2035. I think we're in a very different landscape today, and this has obvious implications on uranium demand. I think particularly advanced nuclear, if you had asked me maybe 6 months ago what my views on advanced nuclear were, I would have said very positive, but post 2030. I think what we're seeing today is big tech are lining up and giving small modular advanced nuclear companies this demand clarity that they did not previously have, saying, you build it and we will buy it. And that was not an environment that existed, as I say, sort of 6, 9 months ago. I spent the last 5 years at these conferences, and people talk, particularly around advanced nuclear, about two issues: fuel and finance. And I think that financing has pretty much all but been solved over the past couple of months for the reasons that we've just spoken about. And also, this is not isolated to big tech. Banks are getting off the sideline now. We saw a large announcement from the world's largest banks pledging towards financing of nuclear power projects. This is because they have credit risk massively mitigated when you have the balance sheets of the least price sensitive customers in the world in Google, Microsoft, Amazon, Meta, all being the end customer for these reactors. So is a huge paradigm shift in the nuclear market and by association, the uranium market. In terms of, the sort of frustration, and I know that we'll talk about this in more detail around spot and the underlying uranium price, that will come. I think the spot market is a speculator's market. It has a sort of short-term view about it. And a lot of this demand from big tech is not going to have major repercussions on uranium demand for, let's say, a couple of years, while this capacity gets built. So I'm not surprised, not overly surprised to see the spot price sort of stubborn at its sort of $80 a pound, albeit from the news flow that we've seen this year, I would have maybe expected it to be a bit higher. But again, as we'll talk about, the term price for us is what the real price of uranium is. That's real utility demand, and we're starting to see volumes pick up on that side as well, which is great.
So current demand is somewhere between 180 to 200 million pounds a year. And if you look out, I know this might be still too early to determine this, but I'm wondering if you and your team have done any work on what demand might be 5 years from now when you have these data centers up and running and you have Microsoft and all these other big tech companies implementing some sort of nuclear energy strategy.
Yeah, I think within the next 5 years, we do see a growth rate of between 3 and 5% in terms of uranium demand. I think that again, the thing that can have the biggest impact on uranium demand in the near term is probably going to be things like advanced nuclear. Again, 75% of these reactors need higher, say, low enriched uranium, but pretty much all of them need uranium in some form. So I don't see a reason why uranium demand in the next 5 years shouldn't, we can't surpass that sort of 3 to 5% growth rate. Um, the one thing that, if you look beyond that, then I think that, our internal estimates see between 250 to 260 million pounds of demand by 2035. This is primarily going to be driven by markets like China, very well documented in terms of their nuclear rollout strategy, markets like India as well, and then also the Japanese starting to bring their restarted nuclear reactors back online. But also, a really interesting report recently that we were looking at is, again, this low-hanging fruit in the US. And this report looked at um, potential capacity in the US that is already licensed. So let's say you wanted to build a 3 Mile Island and you get a permit, you get a license to build 4 nuclear reactors there. But for whatever reason, call it a Fukushima, call it just poor economics at the time, supply chain inflation, whatever you want to call it, you only ended up building 2 of those 4 plants. And then 15 years have passed, and we are where we are today, which is a situation where you've got the report estimates 60 to 95 gigawatts of licensed capacity in the US. Now, we started to look at this at Ocean Wall in terms of how much this can expedite total build times of new nuclear, and we estimate between 5 and 7 years can be taken off the build times of new nuclear reactors, primarily because the permitting and licenses are in place, but also because you have grid connection infrastructure in place. So, you can really start to bring down not only the timelines, but also the cost of these reactors, where you already have existing reactors running, and of course, reactors that are potentially looking to be restarted.
It's amazing what can happen when you get private industry behind some sort of new technology. And when I see what's happening right now with nuclear energy and big tech, it kind of reminds me of what we saw with the lithium in the lithium space. And the auto industry made a big push into EVs in recent years, but they realized, oh my God, we got an issue here with securing battery metals and also the processing of the metals to make these lithium ion batteries. And just as a reminder, China processes 80 to 90% of all lithium ion batteries. So if you're an EV producer, you got to go to China to get these batteries. We saw a number of these OEMs make massive investments into lithium projects and lithium mines. The biggest one being GM. They spent $625 million on this Thacker's Pass project in Nevada. Do you envision the same sort of thing happening in the uranium space where we get maybe big tech making investments in uranium mines?
100%. I think that, the difference that we see today, perhaps, is that those OEMs were able to put that lithium to work pretty much straight away, i.e., the build time for a car is obviously much faster than the build time for a nuclear reactor, but it's 100% part of the future. As big tech start to realize, going back to our, initial point that nuclear is in a league of its own around capacity factor and how clean it is, um, you know, it makes complete sense for big tech to start to invest in the fuel cycle as they start to understand this is, one of the only solutions that they have to power their huge power appetites. Um, as while lithium obviously has a refinement period sort of cycle as well as uranium does, it's probably, well, it's a lot more complex in the uranium space. It's also the people that can do conversion, enrichment, the companies that can do these fuel cycle components are very, very concentrated. We're talking about state-owned enterprises and really only a handful of listed companies or private companies that are even trying to do these types of processes. So I wouldn't be surprised if we saw big tech starting to invest in the entire fuel cycle, whether that's uranium mines, whether it's conversion or enrichment capacity or fabrication capacity. Because one thing that I think the world is starting to wake up to, and I think big tech are sort of coming to this realization now, is you can pledge billions of dollars towards advanced nuclear, traditional nuclear, whatever you want, but it's completely useless doing that until you have a sustainable fuel supply. Um, and this is particularly relevant for advanced nuclear, where we really don't have a sustainable ISA low enriched uranium supply outside of Russia. So it makes complete sense for these companies to start to look. I still think we're a few years away from that, given the reasons that we spoke about around sort of the more near-term demand for cars versus obviously being able to put this uranium to work now. But these guys, if they're making the pledges that they're starting to make, if they're going to back those up, it makes sense for them to start to procure the fuel now in that sort of Chinese mindset, which is, don't let fuel be the hindrance of this nuclear rollout strategy. I think that big tech have got the balance sheets to go away and start to procure the necessary fuel for their reactors.
And what about U.S. utilities? I mean, I'm surprised they haven't already done this, given what's going on with Kazatomprom selling all the product to China and Russia, giving the war that's going on with Russia and Ukraine and Niger and so many other issues. Why hasn't the U.S. utility acquired some U.S. mines?
There are very few, I think, is probably the first answer. I mean, in the first half of this year, the US produced 180,000 pounds of uranium. 180,000 pounds versus 50 million pounds of annual demand. They are currently producing 0.3% of their domestic fuel requirements. They're not for sale because there are none. I mean, there are very, very few. You've got a few sort of 100,000 pounds coming online, ramping up to a couple of million pounds over the next few years. But there hasn't been a domestic fuel cycle in the US for 3 decades. This goes back to the megatons to megawatts program in 1993. The US thought the good times would never end, that they would keep getting their uranium for their entire nuclear fleet from Russia, down-blended weapons-grade uranium from the Soviet war. And then Putin does what he did in 2022, and they're no longer a sustainable sort of counterparty with which to do business. Utilities this year, for them, it's been a year of trying to obtain the clarity, I think, around how they're going to be able to contract in the future. This has been to do with things like the US ban. And I think now they have proper clarity on how they're going to be able to contract and with who. We're starting to see volumes ramp up again, sort of 40 million pounds only a few weeks ago, ramping up to sort of 90 million pounds towards the end of October. So, I think we're starting to see utilities come to market and starting to realize that there is a major sort of crunch coming. I think that's been particularly relevant in things like conversion and enrichment. I think that US utilities, like global utilities did when Russia invaded Ukraine, realized that the real crunch point was going to be conversion and enrichment, given the dominance that Rosatom have on those processes. But that has to trickle down to uranium at some point. I mean, you see, enrichment up 400 odd percent since the war, and conversion up a couple of 100%. That has to come down to U3O8 at some point. That really is sort of your crystal ball, we believe, into where the uranium price is going, from that sort of upstream down to the downstream sort of fuel cycle.
Okay, so there's a lot to unpack there. First of all, you made mention of the fact that there was a few deals in the term market recently. Did you say 27 million pounds?
So we've seen the term market go from about 40 million pounds, sorry, so from about 50 million pounds to about 90 million pounds over the last few weeks.
And do we have any idea who these deals were done with?
So we do know the jurisdiction, and we're starting to see US utilities in particular ramp up. I mean, US utilities were really not active in the term market for most of this year. Even the subdued volumes that we saw were primarily from from European utilities in the first half of the year. We're starting to see US utilities, really come back to market. And again, around pricing, what we've seen is this sort of removal of floors and ceilings, albeit, the sort of floor prices that we're hearing is between $70 and $80. And then obviously the removal of those ceilings, that's really been across U308, UF6, and EUP. So we expect to see term prices pretty significantly higher at the end of November. As I'm sure most of your listeners will be aware, the month-end term prices that are reported take the lowest bid from that month. So the end of October, we saw volumes ramp up pretty significantly in those last 2 weeks, but they took the $81 bid price from, let's say, the beginning of the month. So we didn't see a move in the term price over October. We would expect to see that at the end of November, and we would expect to see that have a meaningful impact on price.
So so you made mention of the fact that US utilities have gotten involved in the term market. Do you think there's a sense of panic starting to set in because of the production problems that we've seen out of Kazatomprom and also the deals that Kazatomprom did with the Chinese?
I think that I wouldn't necessarily use the word panic yet, but I feel like utilities are starting to understand what the reality is in terms of the supply demand dynamics of uranium, which is, again, you have the least price sensitive customers in the world in big tech coming to market and saying, we will buy whatever capacity we can. We will incentivize you. We will pay 80 to 100% above wholesale electricity prices for you to bring online capacity as soon as possible. If that is not an indicator to US utilities, European utilities, any nuclear reactor operator in the world that they need to start to think about going to market today, knowing that they're going to be competing with the likes of Google, Amazon, Meta for those pounds potentially in the future, then I don't really know what gets them off the sidelines.
So you're suggesting the big threat is not from the Chinese, it's from big tech.
I think that on the demand side, yes. On the supply side, again, Kazatomprom coming out announcing their third multi-billion-dollar contract with the Chinese. The Kazatomprom CEO coming out saying that it really makes more sense for them to just ship to the Chinese or to the Chinese and to the Russians, essentially removing the West from their contract books. Now, I'm not saying that they will, but it seems like when you look at their financial statements that a large chunk of their revenues are now going towards China alone. And that's not surprising given what we know about the Chinese sort of nuclear growth story. But it does paint a really vulnerable picture for the West, which is if you are a Western utility and you're the US, for example, and you are reliant on Kazakhstan, Uzbekistan, and Russia for 50% of your fuel cycle, and your fuel cycle powers your nuclear fleet, which is responsible for 55% of your clean electricity and 20% of the grid, and then you look at your domestic fuel cycle and you're producing 0.3% of your domestic consumption, why shouldn't utilities be panicking? There's no, they're operating a conversion and an enrichment deficit for their domestic fuel cycle as well as U308. They can't just rely on Canada to do their pounds out the ground or their domestic conversion and enrichment to complete the fuel cycle. They're finding themselves in a particularly vulnerable position now. And this has been clear to us for a while. But what wasn't clear to US utilities was when sanctions were going to come in, and as I mentioned, who they were going to be able to contract with. We've seen waivers being granted. I wouldn't say rubber stamped, but they're being granted to most people, it seems, that are asking for them. But we know that from 2028, Russian uranium, whether it's U308, UF6, or EUP, is not going to be allowed into the United States. There is a reason why there was a 2-year lag in sanctions for uranium into the US while they were sanctioning every single other commodity coming out of Russia, because they are pretty much solely reliant on the Russians and Kazakhstan and Uzbekistan on Central Asia and Russia for their fuel cycle. So I think that the supply side fragility is a story well told. I think that people have almost forgotten about it because of how much noise the demand side has been making. But you're completely right. I mean, look at Paladin, a 40% increase in their production costs. Uranium mining is not easy, as we're starting to find out. And I think, when people look at projects to come online, your fissions, your next gens, um, they sort of write those things up to 100% of what management have guided to. It's going to be really, really difficult for them to meet that. It's going to be exactly the same in the US. I've heard people talking around 25 million pounds of production coming out of US uranium mines. It's going to be really, really difficult because of many reasons, but I think one of the main reasons is skilled labor. Again, there hasn't been a domestic fuel supply in the US for 30 years. How are you going to find these uranium miners out of nowhere? When there was no fuel cycle, there was an exodus of talent from this industry, and they went to the metals of the times, your lithiums, your cobalts, your coppers, companies and metals that were able to pay them significantly higher salaries than uranium, given the fact that the prices had come off so much. So I think that it's a balance of supply demand fragility, fragility on the supply side, and obviously really robust demand growth. But the confluence of those two things puts the West especially in a particularly vulnerable place.
It sounds like 2025 is going to be one hell of a year for uranium.
I wouldn't be surprised if it was.
Okay, so you made mention of the fact that 90 million pounds have been contracted so far, and we still have 2 months to go in the year. Where do you think we end up?
Well, if you take the trajectory of the last few weeks, then 150 plus. Whether or not, again, it's incredibly lumpy. Term market volumes are very, very lumpy. That's been the case for as long as I've been looking at the market. So, you can see these one-off term market contracts, like the Ukrainian contract with Cameco last year was like 40 million pounds. So, one or two of those, and we're sort of near replacement rate contracting, sort of similar to last year. But I would say around the sort of 130 mark, I wouldn't be surprised to see. But again, a couple of those large contracts, and you could see us surpass that quite significantly. But there's no way in which we see 130 or 150 or 160 without us seeing significantly higher prices.
I want to ask you about equity valuations, and there's been a big divergence this year. You can look at a name like Kazatomprom, it's down on the year. Cameco, it's up 30% on the year, but a lot of that move came here in the last few weeks on the back of the Microsoft news. And then you have very specific names like NewScale, it's up 500% on the year. Lightbridge is up 300% on the year. Do you think some of these stocks have gotten ahead of themselves?
I think that a lot of the move in the equities was around the demand side, and I think that a lot of the move was under the expectation that we would see the underlying commodity price move, and we're sort of yet to see that, obviously. So from a valuation perspective, possibly, but again, if you are a believer like we are that we're going to see significantly higher uranium prices, then probably not. The one thing that I think is that with nuclear in the headlines as often as it is, there's very few names to own. So you can go away and you can buy a utility, but the utilities, as you say, Constellation, etc., are up 100% already this year. So then you go to your second derivative, which is what fuels these utilities, and you go down to your uranium names, and there's about 80 names that you can own, of which there are about 5 or 6 producers. So again, an incredibly concentrated number of listed names you can own, particularly liquid listed names. So if you're an institutional investor and you want to put 50 to $100 million to work, you really are confined to 3 or 4 names. Then you can go down to the sort of second, third, fourth derivatives, which are your picks and shovels plays. So development, exploration, and then obviously your sort of enrichment companies. I think that across the board, valuations are probably fair, but that's at today's uranium prices. I think, again, if you are of the view that uranium prices are going much higher, which we are, then of course you can make the justification that these equity prices are undervalued. But I think that, again, we're starting to see this, and I think that's particularly relevant given how concentrated the equity markets are in terms of how few names that you can own. So I think they've got a way to go yet. I think you need to be slightly more selective today. As you mentioned, it's been a real roller coaster of a year in terms of, a couple of months ago, even just before you and I met at WNA, equity markets, particularly uranium, were really in the doldrums. That they had suffered sort of over the entire summer period, and spot hadn't moved. And then we saw uranium equities rally sort of 40-50% across the board, and spot didn't move. So I do feel like it's slightly disconnected from just the spot price now, which I think is a good thing. I think, again, ultimately, if you're going to peg uranium equities to any price, it should be the term price. But then people are starting to take more notice, and we're starting to see massively increased volumes in equity markets, particularly in uranium names, from the sort of interest from big tech, understanding that these guys can put billions of dollars to work into the sector.
And Ben, maybe you can tell us about some of your high conviction trades, and that could be involved in any part of the fuel cycle.
Sure. I mean, I think that given everything that we've spoken about, being aligned to North American jurisdiction companies is not a bad thing. I think that a premium should be placed upon these companies. I think that there is a scenario in which we have an Eastern and a Western uranium price, given how bifurcated the market has become. With that in mind, names like Uranium Energy Corp, with the largest portfolio of assets in North America, is interesting. We've been massive fans of Fission Uranium Corp over the past several years as well, albeit that they're under review for acquisition from Paladin. In terms of exploration names, we tended to not want to take exploration risk, given our conviction in the underlying thesis. The one sort of name to buck that trend is Sky Harbor, we think, with the largest portfolio of assets in the highest grade uranium district, the Athabasca Basin. They also operate an interesting earning model, which is fairly non-dilutive to investors. So that's kind of on the mining side. UEC, Fission, and Sky Harbor would be our three names in those segments. On the physical side, we would probably take Sprott over Yellowcake, purely because we believe that they can actually properly put some money to work. Doesn't trade at that sort of double-digit discount that we've seen from Yellowcake over the past the past couple of years. And I think that their model is slightly more flexible in terms of being able to go to market when they trade to a premium. And then our picks and shovels ideas are ASP Isotopes, who only a couple of weeks ago received that TerraPower agreement, which was massive validation of their technology. We believe they're going to be the first to market HALEU producer outside of the US, and we believe they're going to be really the only scalable producer of HALEU globally. And it's great to see someone as credible as TerraPower, sort of placing their bets with someone like ASPI. The other name is that we've been looking at over the last several months, actually really the best part of a year, has been Lightbridge Corporation, who have a patented nuclear fuel casing technology, which can improve the efficiency of nuclear reactors by up to 30%. It can be retrofitted into nuclear reactors during a single fuel reload. And if you think about that improving the efficiency, the power efficiency of these reactors by 30%, it's like building an extra 120 nuclear reactors globally off the sort of 440 we have operating. So those are our sort of five names across, every component of sort of nuclear and the fuel cycle.
Yeah, I wish you told me about that Lightbridge 6 months ago.
Yeah, it's been a hell of a month or so.
So Ben, you recently wrote a note on high assay low enriched uranium, or HALEU, and you mentioned this earlier, but Russia has a monopoly on uranium enrichment services. Maybe you can just tell us about HALEU, what it means, and what's the impact, and why investors should be aware of it.
I think that we can find ourselves in a situation in the not too distant future where the HALEU supply deficit dwarfs that of the EUP, UF6, U308 supply deficit. That's because, there's plenty of uranium in the world. It's just really hard to get it out of the ground. And the process of getting it out of the ground in the West, let's say, takes 10 to 12 years. And then obviously the fuel cycle is constrained, but these are industrial processes and you can build out that capacity over, let's say, 5 to 7 years. So these problems can be solved for, albeit I think there's going to be a supply crunch in that interim as we sort of continue to operate our global nuclear fleet. The reason that HALEU is so important is because 75% of these approved designs globally for advanced nuclear reactors, SMRs, AMRs, require HALEU. And again, for those listeners that aren't aware, HALEU is just a slightly or a much more enriched, actually, version of LEU to about 19.75% of the isotope U-235 versus traditional LEU at about 3 to 5%. What this means is obviously you need a much higher enrichment factor. The world is currently trying to solve for this problem using the same technology that it is applied to LEU. So 40-foot centrifuges, these huge cylinders that you would have seen from the likes of Centrus and Rosatom. And we think it's going to be really difficult to scale the production of HALEU using centrifuges. I think that it wouldn't be surprising if the world views centrifuge enrichment in the way that we do it today, in the same way that they looked at gaseous diffusion before centrifuge enrichment became a sort of commoditized way of doing enrichment. And so we're placing our bets, as I mentioned, with companies like ASP Isotopes, who we think are going to be able to scale this technology at much lower cost. So the TerraPower, the Centrus CEO was on 60 Minutes actually last week talking about how they plan to build 11,000 centrifuges over a sort of 6 to 7 year time period. The capex on that must be multi-billion dollars. I mean, I would assume between sort of $3 to $6 billion. And I think that can't be, I think the world needs HALEU demand. The HALEU demand today is, let's say, in the single digit tons. The NEI estimates that this can go to 600 tons per year by 2035. The only commercial supplier of this fuel is Rosatom. And everything that we're learning about the world today, the geopolitics of the world today, and the environment we find ourselves in, shows us that Russia is not a reliable counterparty with which to do business. We have to find Western-aligned suppliers who can solve for this upcoming deficit. And I think that we're seeing billions of dollars and pounds of government funding being put to work in quite dated technology. And whether it's ASP Isotopes or whether it's the other bunch of other companies trying to pioneer this rush towards HALEU, we need as many companies trying to do it as possible, because it's an impending supply crunch that we see coming in sort of maybe 5+ years time. But these companies need to start to procure these pounds or this fuel today. And maybe just a final comment on that, Jimmy, is that a lot of these SMR companies, so take an Oklo, for example, they had financed their reactors under the assumption that HALEU would cost them around $7,000 a kilogram. If you take the input costs of uranium ore conversion and enrichment today, and you want to ramp that up to 19.75% enrichment, you're looking at $25,000, $30,000 a kilogram. That takes IRRs from the mid-teens down to zero for these reactors. So it just won't work using traditional enrichment methods. There has to be a more scalable, lower cost solution.
Well, fascinating discussion, Ben, and I want to thank you very much for spending time with us today. If somebody would like to follow you online or see your research, read about your research, where can they go?
We publish most of our broad reports for free at oceanwall.com/reports. We also have a Twitter page, albeit it's not particularly active, at oceanwall2. And then I can be reached on ben@oceanwall.com.
Ben, once again, thank you.
Thanks, Jimmy. No problem.